What if the interest rates drop further and I'm stuck with a higher rate?
Firstly, I love this question. We have interest rates that are as low as they've literally ever been in history, right? And I have this conversation with clients every day. I'm saying, look, this is what we're looking at. We've got this rate, we've got this rate, we've got this rate. But let's be honest, the worst of these rates is far better than anything you would have got 2 years ago.
Yes.
Better than anything you would have got 12 months ago. Even home loan rates under 2%, less than 12 months ago, I remember hearing on the radio, St. George was making a big radio advertising campaign about, we have our new home loan rate that starts with a 2. And this is a huge thing, right? We now have one that starts with a 2 and follows with a 0. Like, what do we do? Like, every rate is really low right now. But to actually answer that question in practice, when we've looked historically, banks have generally maintained somewhere around a 3% profit margin on their money. RBA rate to lending rate, around the 3% mark. Up until about 3 years ago, when that started to get squished. We had really low RBA rates, that started to get squashed. Right? What the bank profit margin requires, about roughly a 2% margin. That margin's required because the bank pays their staff. Right? They pay a rate for the money, they pay their staff, they pay for their branches, they pay for their technology, they have a lot of overheads. And that margin's been crushed back and back and back and back. And this is why you see banks not passing on interest rate cuts. Right? As that rate's gone down, we've seen banks passing on less or passing on nothing. Right now, we have interest rates that are in the low 2%. Variables are a little bit higher, but a lot of our fixed rates are in the low 2%. And we still have a 0.25% RBA rate. If that RBA rate were to go to 0 or below, and I think that's not particularly likely, but we'll work with that assumption, the banks still aren't paid to take money. Right? They're essentially now getting money for free. So you could see that rate drop a fraction, but to go below 2% goes against their profit margins. We'd have to see a fundamental shift in banking rates. And the crux of that question, if you were to get a rate in the mid to low 2% on your home loan, or around that 3% mark on your investment loan, and rates were to go lower, are you honestly in a bad position?
Yes, I started.
Just before I finish that,
Yeah.
You have a rate that is better than anybody in your generation has ever had. Right? You have the best security possible. The fact that there is now a cheaper rate in the market means that you will benefit even further in the future. That's a fantastic position to be in. Let's not look at that as a negative.
I started investing back in 1999, and I remember that in 1999 I was so proud of myself because my home loan was 5.95%. So I didn't know many people below 6%. I thought I was doing really, really well, and I think I was doing really, really well, right? And it's speak about 5.95% at the moment. So I think everything is perspective to a great extent. I think the view that I would be taking is that more of the lateral view, and the lateral view would be that what is the rent that I'm receiving at the moment?
That's right.
And what's the interest that I'm sort of paying at the moment? What's the gap? So we can't be in a position where we're always chasing our tail. It's our individual circumstances, right? And very often when we do the fixed rate, I think the view at time comes in is that, am I getting the lowest level of fixed rate? That's fine, I understand that view. But I think a contra view to this is that, am I comfortable with that rate over the next 2 years? So if I look through, that's my income, that's my expenses, let the world do what it does in terms of the interest rate side of it. What is my net balance? And if the net balance is what I'm comfortable, then you know what, that's an active decision we make.
And you touch on a point that I think we'll cover off a little bit later as well. But there's far more that goes into these lending questions than the interest rate.
Yes.
When I am sitting down with a client for the first time, I talk about your 3 main factors, right? And interest rate is one of them, but technically it's the least important, right? You have structure in there, right? And you have repayment type in there. And both of those are actually more important than the rate you're getting. People willingly are paying a higher interest rate for interest only because their cash flow and their tax position is improved. So your repayment structure is more important than your interest rate. Your structure is far more important to your end return.
And you know, I look back into my side of the investment side of it, because I've been investing for about 19 years or so. I've got a whole bunch of structures. I've got trust and company, and so as you naturally do. So I went through from sort of beginning sort of the investment to sort of sophisticated investment to a level where it's probably too confusing to me as well, right? So the question is that how do I still qualify the loan?
Yeah.
And I had to make a commercial decision from my end, is that I'm with business banker,
Yeah.
I'm with private business banker, and I've actively taken the interest rate where it is touch bit higher, as opposed to your no frills sort of a mum and dad sort of the investors as such. Yes, okay, there is a slight level of higher level of interest rate that I'm paying. But the other side of that equation is that the borrowing ability that I have. Other side of that
absolutely.
equation is that private bankers, as an example, is the commercial mind that they have and sort of the bigger picture that they have. And I sit down and I do the maths that if there is a 0.25%, 0.5% additional interest, but if that allows me an additional purchase or two additional purchase, I use the compounding and I sort of say the growth factor over a period of time and what would be the end result in the longer period of time when I'm being thinking at that short term, the interest rate.
Absolutely.
So I think the lateral thinking is very important in my mind.
Absolutely. And at the end of the day, if you really want to make sure that you're going to benefit from every rate reduction and everything, you look at a variable loan. Most lenders will have a loan that will track, or some lenders anyway, have a loan that directly tracks the RBA's rate. You get a loan like that, you will always follow the market. It still isn't going to be the cheapest because those lenders aren't able to leverage those loans as aggressively, but at least you know you will always follow wherever the market goes. So there's always solutions, there's always protections. The question is, do you understand the investment you're making and why you're making those decisions? That guides your decision making much better than
Yeah.
simply chasing a rate.
It's more important that you get a loan than worrying about interest rate. 0.25, 0.5, in a longer period of time, you won't be thinking about that when you're probably going to double over a period of time.